get back to marketplace. We live in a volatile, uncertain, complex, and ambiguous time, and in particular for investors looking to navigate the various headwinds that threaten their assets and portfolios on a daily basis. On Tuesday this week, yesterday, Cowry Asset Management added 3 new funds to the increasing size of mutual funds market in Nigeria, and a panel of professionals was also put together at the event to discuss how retail investors can make the right investment decisions under the present circumstances. Let's take an excerpt.
Income is constrained. How then do I make the decisions? We don't want people to be like those who used to. I know, thank God Dr. Bayolubimi is here. I'm sure he would attest to the fact that things have changed and times have changed. After the 2008 crash, when some people used to have an investment, you just, what I call the heads effect. You just hear people then in the streets, Broad Street, what is it today that you are buying? Okay, total. People will quickly go, what is it again you are buying? We are buying First Bank shares. Without knowledge. And we saw the crash. And some of those people sadly laminated their certificates because for them it was a sign of treasure. And then the market came crashing. So this is why we in Cowry feel that the need to set up a fund like this, as mutual fund, we address the needs of the challenging times and decision-making, guided decision-making process, because we are able to navigate the risks that are inherent and those that are perceived.
So the first thing I'll say to you is, please do not borrow to invest. Invest your money, because when you borrow, it's a guaranteed debt with a guaranteed interest or whatever form of return on that debt. Your investment does not give you the same guarantee in terms of returns. So invest your money. That's number one. Number two, decide on your risk appetite. Okay? High risk, high returns, but volatile. Now, as you heard, I'm a professional. I'm a senior advocate of Nigeria. So my work is, I earn money from the work I do. I invest for the period when I'm unable to earn. And therefore I have a low risk appetite. So you decide what works for you. And the professionals will assist you to make that analysis. So I'm quite risk averse. These mutual funds would work for me. The next thing I look at is, what sort of service provider do I want? Again, I'm a busy professional. I don't have the time to chase you around to tell me what you're doing for me. That's why you're getting paid a fee. And some of the bigger companies treat you like, how you go to the supermarket or you go to your local corner shop. There's a difference. They know who you are. And they give you a more bespoke service. So I worked in England for many years. I started investing with my first income there. I have comparison both internationally and locally. And when I began to make sort of think about how and where to invest here, of course, the first people that came to mind was Standard Chartered, because they're an international bank. And they have an arm that does something similar to Cowry. But having engaged with them from an investor customer perspective and having engaged with Cowry, I'm pleased to say I made the decision to go with Cowry.
when you say complex, complexity has to do with the interaction of multiple factors. You have so many factors, particularly now that we have even disruptions from the technology, and also disruptions coming from ever-changing need for what we call the ESG environment, the environment, the social and the governance environment. All these are also compounding the complexity of investing today. And then finally, you have the ambiguity. Ambiguity means there is lack of clarity, in terms of the investing environment. So if you look at this VUCA world or VUCA market, Professor Johnson has also recommended the way to address threats coming from VUCA. I will just quickly mention Professor Johnson's recommendations, and then I will also go into my own recommendations. What Johnson said was, if you want to address VUCA market or VUCA environment, you also use the VUCA approach. And what is that VUCA approach, or what he called the VUCA prime? Volatility. If you want to address volatility, address it by using vision. He says, recognize that volatility exists. According to him, is a mindset. So investors should be able to recognize that this is something that is bound to happen and shouldn't resist it. So they should prepare their minds that markets are, subjected to ups and swings, ups and downs. And then with respect to uncertainty, he says the investor should approach that with understanding. Another U. And understanding means, if you like, one of the things he recommends there is to regularly do this what we call the EIC framework, the Economy, Industry, Company Framework. Those of you who are familiar with fundamental analysis will understand what I'm saying. So continuously do your fundamental analysis to be able to identify largely mispriced stocks. I think Mike said it, identify stocks with the right fundamentals. So he says to address the uncertainty, you also use understanding. And he says to address the complexity, you apply clarity. So with relation to your clients, you communicate your strategies very well so that you carry them along when you are managing your funds. If you have to change, for example, in this period, if in a period of volatility, you may need to change your approach. For online trading, for example, you may need to migrate to manual, then the client has to be carried along. So for the complex situations, you use clarity. And finally, for ambiguity, he recommends agility. And what does he mean by agility? He talks about flexibility. That in funds management, you should be able to be flexible. So that's Professor Johnson, managing the VUCA world using the VUCA approach, or the VUCA prime. Now, my submission, finally, with respect to the VUCA market or VUCA environment is to adopt what I call the DHL approach. The DHL approach. What is the D there? The D there stands for diversification. This is something we all know from theory, that your best bet is to ensure that you have a diversified portfolio, ensuring that the securities you have in that portfolio have negative correlation. They are negatively correlated not only with each other, but also with dynamics in the economy. So diversification is very key. It was Warren Buffett that said that it is better to buy a wonderful company at a fair price than to buy a fair company at a wonderful price. That was Warren Buffett. Okay, so diversification is key when we want to manage volatility, uncertainty, complexity, and ambiguity. My hedge in the DHL is hedging. How do you, when you have an environment that is full of risk, you attempt to hedge? The good news is that in this economy, in this market, we're beginning to introduce financial derivatives, but particularly when your portfolio is comprising foreign stocks. So you need to use some of those hedging tools, to be able to, minimize your downside or provide downside protection. One of those tools we all know is, for example, you could do a protective put. A protective put, what does it do for you? It ensures that it provides you with downside protection. By the way, what's a put? A put is what gives the owner the right, to sell at a specified price, of course, on or before a certain period of time, without necessarily giving you the obligation. Okay. Another way to hedge is to also see if you can buy and sell buy a put option and buy a call option at the same time on the same underlying asset. Okay, yes, I'm rounding off. Okay, I'm just saying that you can do what is called a straddle. In a straddle, you're buying a call option, you're also buying a put option. At the same time, they have the same strike price, they have the same expiry date. You do that to be able to hedge your loss. Finally, is the L, DHL. The L there stands for what? What Mike has said. You adopt a longer term, perspective. Always ensure you're revising your portfolio, you're evaluating your portfolio, particularly using the known the Jensen method for portfolio evaluation is very appropriate at this time. You have the Sharp, you have the Trainer, but more importantly, the Jensen, because it's that Jensen approach that helps you to seek alpha, superior returns, more above the market.
The decision about what instruments to invest in, principles have never changed, which is to say you have to look at the fundamentals of the stock, you have to look at the fundamentals of the investment, and then you have to have a long-term investment time frame. The problem most investors have is they look at the short end of the stick. I don't regard such people as investors, they are speculators, those who want to ride the market, and frequently they get into trouble. But if you look at the fundamentals of the company in which you want to invest in, fundamentals being in what sector of the economy they're operating in, what kind of business they're doing, the character of the management, the expertise they have shown over time. If you invest in them, then temporary dislocations of the market will not matter so much to you. Secondly, it's important at a time of instability that you rely extensively on the experts, which is why a mutual fund is a very veritable instrument at a time like this, because we're relying on the expertise of those who have the information, the market information, and who can guide you properly in your decision making. I think that is what I would consider the most important thing, the fact that you are investing in the fundamentals of the company, and secondly, that you are working with experts. I think that is what is critical.